What'd you have for breakfast this morning?
I had coffee and an orange.
So are the acai bowls better in Solana Beach, or?
I've yet to try out the acai bowls in Solana Beach, but I have to say that South County coffee absolutely dominates compared to North County. I haven't had a good cup of joe in North County since I lived there.
Right.
Mm-hmm.
Okay. That's good.
Yeah.
Well, good. Just wanted us to get together and chat a little bit. I think we had a pretty crazy, I wouldn't say crazy, but interesting 2020.
Yeah.
So just kind of wanted to, all of us get together and discuss some of everyone's feedback and what we thought of, what happened and, what transpired with the buyers, sellers, properties, remodels, contractors, and so forth. So,
yeah.
So Keith, with that, we'll just try to get your perspective as you having the touch with the market.
I think in the beginning it was, unprecedented, right? We had no idea what to do. CAR released the PED form, which we're all very familiar with now. And it was a little bit of hysteria, but at the same time, we had maybe 5 or 6 escrows on March 15th when we got shut down. And I think all but one of those ended up closing. So even though we got, airports, schools, businesses, everything shut down, the escrows ended up closing. Shortly after that, we still started to get showings, and the train was kind of moving whether or not the world was stopped. So I think the hysteria came in the first 2 weeks. The CAR came out with the PED and the expectations of the buyers.
That happened quick, huh?
That happened quick, right?
I think for us, what you say was it? I wrote it on my calendar. It was March 19th was when I called it, shit hit the fan day. So what was it for you? Like, what did you feel like the world is about to change?
Or like it was interesting because I remember that me, you and Jamal sitting in the office. We decided what we're going to do. We're going to sell the houses. We're going to buy these houses.
Yeah.
What's the plan in the next 6 months? We didn't know what to do. What to expect. Were the tenants going to pay rent on our rental units? The escrows that we had in place at that point in time. Should we buy the home? Should we, just let our deposits go? It was a very interesting and difficult time. With that said, I think over the course of maybe 2 weeks to a month, things just completely went opposite than what we projected things to happen. People became comfortable with the fact that people are becoming their homes. The fact that we had vacant homes that were remodeled, that people can go view, was critical and important. And I think that kind of set us above the other groups and flippers that are out there. I think we maybe had like I said, 10 or 12 properties in escrow, and some of those we had to buy. We were stuck buying them. So we're like, what's going to happen? So we closed on them, we bought them, and then a month later, completely opposite than we thought. Just took off. Just nuts.
Mm-hmm.
So 2020 was an interesting year because I think we sold 98 homes, and every single home we sold last year we sold above our list price.
Yeah. So
forecasting, I think things will stay the same. I don't know if we'll be selling that much above the list price, but I think 2020 was a very interesting year. Like you said, the PED came out. We were going through the PED, trying to understand the PED. There were gloves. You had to wipe on everything in the house. The agent would stand outside while you walked inside the house. But the fortunate thing about that at that point in time is we had homes that were vacant. People were comfortable still going in those homes, and people were so concerned about getting out of the city downtown. I remember downtown was completely opposite. Everyone wanted to move out from downtown. So 2020 was a phenomenal year for us, probably our best year of all time. I think we sold $65 million worth of real estate. But moving into 2021, it was a great year for us.
And to that point, I think when the PED came out and you still had essential businesses going, right? I remember specifically talking to one buyer who worked for the city, doing stuff with the lampposts. And I think that's when we're like, okay, there's still essential businesses. How can we reach those people? And then we implemented the 3D tours. Shortly after that, within 2 weeks, we're like, how can we get people to see these houses in the same amount of volume, but safely, you know. And
that was interesting. Just to kind of rewind the tape on that. For us, I like to think kind of like pre-COVID. So we were in February, late January, 2020. I think we had Palomino.
Yeah.
It was on the market.
Yeah.
I'm just like, this house burned down. We just put it back together. We're doing the most. We have the most sizzle on it. And I'm usually optimistic on you know, I'm like, man, the house has every, you know, we went into it and I'm thinking like, you know, there's not a whole lot you could say wrong about it other than it's small. So that's why we ventured into it. I'm checking Mark, looking at every comp. I can't find anything above 2 million to save my life.
Right.
So I'm like, you know, I'm going back, reviewing data over data, bringing 2 agents from that are no La Jolla back and forth. They're like, look, you guys can get 1.9 or 2. You should. And when we had that offer, and you're like, you know, I'm like, are they sure? And then we have it listed at 2% commission.
Yeah.
So when
which is the norm now, right?
Right.
Yeah. So when that tick, you know, it's funny. It's like it's like looking at. So when that kind of price locked in, I turned, I think, optimistic right at that point, because I'm like, this just tells there's something we don't know here.
Right.
So it was very interesting because we had the competitors who were in complete panic mode. They were just dumping everything. It was like straight up from that movie, Margin Call, where the guys call in selling bonds and just dumping every property. It was a perfect replay of that. They were even calling in with as different company names, trying to dump properties on us. I'm getting calls like 10-5. Hey, you gonna want to buy this property? You want to buy that property? Then the owner calls me, calls Farouk, freaking out. Hey, what are you guys doing? And I think we just had a little bit of that pulse signal of, hey, you know, maybe this is maybe there's a little turnaround here.
If Palomino can close.
And we were cautious because I think Jamil brought some really good properties to us. Right, Farouk, that one that. And we kind of skipped on some of them because we were like, you know, we still don't want to take too much risk. We just want to take our comfort risk, right? Would you say, Farouk?
Yeah, and I thought at that point in time, if you got stuck with it, could we sell it, you know? Or, you know, could we rent it out and could we still cash flow during that point in time? It's interesting because on Palomino, that's on February, in March, got the tail end of that. The last second, man, I hope this closes, you know? They're going to cancel this. Remember that last thing, they're going to cancel this. And it closed in, I think it might have been only 2 properties that we probably missed out on that time. There's one on Lemon Grove. Remember that gravel road? That we didn't buy? And there was another one, they were trying to wholesale to us.
The one with the backyard. It was a bigger remodel, yeah.
There was one that were trying to wholesale to us. I think it was in Nashville City for $325, and we should have bought it and go back and forth. And interesting, it always seems like when everyone gets scared, it's the best opportunity to buy. And that's for anything. Stocks, some cars, someone, whatever it might be, you know, when everyone's scared, it's the best opportunity. And, you know, the stock market had crashed, you know, we're sitting there, like, what are we going to do with all the, you know, property we have? Let's get some cash and put it in the market, you know, and buy some bonds. Remember we were talking about that? Buy some bonds at 0.5% rate, so we see, this is money.
Like deers on headlights. This is what happens, guys. So one of the, you know, not to spin this off from talking about real estate, but overall, one of the things that, you know, it's not what color door, it's really all about your investment principles, you know, like you turn a good product, but it's also you have to be really good investors, and a lot of people just don't educate themselves enough in terms of investments and just panic. You know, if you panic, you set panics, then it doesn't allow you to think rational, and you make a lot of bad decisions. For example, I'll give you guys some others. It's just the markets I track, the coastal markets. There's a lot of properties that were, because we were in that $2 million price range, so I'm tracking some properties that were coming on market, and I'm like, wow, this one's like 0.2 mile from the beach, and they're selling at 2.4. The guy flipped it around into a rental 24 month, so he locked himself back into a rental cheap.
Wow.
So he can't sell it because he got these people moving in from Colorado, and
Signed
had he just waited like a little bit, just let himself breathe a little bit, he would have just sold it and took his profits and moved on. Other agents were told, oh, we're going to take it off the market, you know, and we're like telling them, like, no, we got an offer on ours, like maybe you should. So it just goes to show how many years you have experience. If you don't think rational through crisis, you're really just it just is. And then of course, I think Keaton, you've done a wonderful job with all the newer implementation, as well as all the construction team did a great job with all the newer implementations. We kind of realized that people are going to want to work from home, and I think we noticed that. What would you say about summertime, or like when are you noticing kind of people were asking for more square footage?
Yeah, summertime was a buzzword. I mean, it was work from home, home office.
Yeah.
You had the Zoom meeting commercials that everyone was kind of partaking in, and it was there's memes about it, and everyone really wanted a space to work from home, and I think it was a buzzword. Now I think that as we kind of adjust, it's a necessity, right? It's
right.
It's fun to have an office, but now I really need an office, because this is kind of how things are. And to your earlier point, when people were panic selling and stuff, that there's no textbook on how to sell millions of dollars of real estate in a global pandemic, right? You're kind of just bobbing and weaving and looking at the worst case scenario of can this be rented out, and kind of keeping your cool, right, and seeing how it plays out. I think that people are adjusting now, and are looking for those places, and like you said, the design team did a great job of finding those little nooks and those pockets. Like we just closed on one in Vista that was solely bought because it had an office den that was for a teacher. She's a teacher, and nice. So her daily routine is on Zoom now, and so now she has a space to get that. But yeah,
no, that's good. Another thing, of course, to contribute to the panic was just correctly controlling. If you're operating a company with debt, with leverage, is to do proper control on that. And of course, Farouk did an awesome job with managing that side of our business. Probably can share a little bit of your thoughts on that, Farouk.
I'm sorry?
Leverage, to just basically to be able to stay at
You mean managing assets?
Yeah, managing asset. With every one of our properties and every investor, rarely where they're just buying a house cash with their own cash and just putting in more money of their own. So you have a lender involved, and the amount that you borrow against the property plus the amount that you put into it. If you're doing 2 houses, that's manageable, right? You could do that off your quick calculator on your iPhone. But as you're carrying in 20, 30, 50, the scale starts moving. There's a lot more dynamics of how money has to flow, and so there's a lot of discussions on us doing financial modeling on that.
Yeah, at that time was an interesting time because we had properties that we had to close, and we had banks that stopped lending, right? They just froze their account.
Wow,
that's right. It's interesting because they were calling us back and saying, "Hey, we can lend you guys, but instead of lending you at 85 to 90% because we have a good portfolio of business that we close over time, they said we're going to drop it down to 60%. So you need to come to 40% down, plus your rehab money in order for you to be able to acquire the property. So to try to manage the 10 properties we have coming in, the few properties that were sitting on the market for a while that the market hadn't turned within the first month, and trying to make sure we had enough capital to buy those 10 to 15 properties, and also have enough money to finish renovations, be in place for any emergencies that come out so we can debt service the debt that we had on the books. All those things, it was kind of playing, I was playing poker with myself, basically trying to, what card do I play here, So, interesting time. The fact that we had a decent portfolio of cash, and we had a good sound investor pool of investors that were backing us, allowed us to still continue to buy some properties cash. And when the market started correcting and changing, we were able to refinance out of those and get a better interest rate and fees and be able to manage those. But it was a very interesting time. It was constantly playing chess. If you buy this one cash, can I refinance it? Is the lender going to allow us to refinance the property with it falling off the hill? All those things come into play, and trying to manage those funds. So I enjoy it because it's a challenge, right? It's like anything else. It's a challenge. So.
What properties do you decide to, if you bought something in cash, do you identify that property as, okay, well maybe we could put hard money debt on this one? Is it just like a risk versus a safe bet versus a riskier property, or is it a dollar amount?
Well, it depends. Some of the properties we think we're going to end up holding for a while that have city-related issues, longer renovation time periods when we might get shut down, we try to buy those cash.
Okay.
Because we're not debt servicing them. You know, we have property on the books right now that we've had, you know, for example, a property that we had a year and a half. We have, was it
Ridgecrest?
Ridgecrest. We've held that property for 2 years, and we pay cash for that. So we're not debt servicing the debt. The only debt we're really debt servicing is utilities, and then the property taxes, and then insurance. So properties that we have that are going to be longer holds, or properties that I'm pretty confident that we can get our money out really quick, like a clean property, and any lender will lend on those properties. Those are the properties that will fund with cash. Also, what comes into play, keep in mind, these are 10-day escrows, right?
Right.
And so these are 10-day escrows, and then we're still making the decision in the last minute, and sometimes the financing isn't in the place to be the fund closing those properties, so we got to close cash. Got to close cash, go out and close cash the next day. I'm getting, you know, the closing statement, the grant deed. I'm sending that to our title, open up a refinance. Loan docs coming in, I'm having to run over escrow, sign with loan docs, and then the cycle it's just constantly just turning, you know.
Mm-hmm.
It depends, but typically, for safe speaking, properties are going to be longer holds that are challenging properties that we think that we're going to have a tough time with the city, or where the renovation costs being higher. Those are the ones we typically pay cash. I'll wait for a time period where we can start the construction, where we think we got past the point where the city might not be knocking on our door and asking for more permits, and then we'll refinance those properties at that point in time.
So on that same example, if you buy a property with hard money, thinking that it's going to be, you know, a quick exit, and something comes up, at that point, do you ever say, okay, well, this is going to be, you know, a 6 to 8 month thing. Let's go ahead and buy out this hard money and replace that debt with cash, because you know that you have 6 months.
You know, we have not done that yet. Knock on wood, we probably should have.
There's a few we
on a
should
few
have.
properties.
And again, yeah.
But we also have to consider, you know, is it worth
Eating the points of the hard
or is
money.
it worth taking that cash and putting on a property where that cash can be used on a property that might turn quicker, right?
Yeah.
Right? Because the next property that comes up, might be a property. Oh, that cash that we have might be used to buy 3 or 4 properties, right? With the down payment we have and renovation costs, it might be used to buy, you know, like 3 or 4 properties. And can that cash and those returns be able to debt service that debt that we've had been carrying for the last 12 months?
Right.
So in a lot of cases, you know, we would elect not to do that.
The finance term for that is called positive carry. It's something that, you know, like if you look at all the, you know, comparing real estate to as a warrant, or to like the guys who do bonds,
Right.
that trade bonds. Everyone's like thinks, well, the guys who do bonds, well, they don't make any money because the bonds are only 2%. And actually, they make the most amount of money out of all, because they're constantly using these type of strategies as you know, taking in, you know, yeah, you're taking some debt at 6 while you're trying to generate 33% return, 20. There's no point of paying it off, tying up your cash, where you could still be out there doing little additional leverage. And of course, these points don't start to make sense until you actually get to good size rhythm with the business.
Right.
For an investor just starting, it's 1-2 property. You know, it's pay one off to pay the other, put 2 in escrow. You know, once you start getting to about 10, that's where you can kind of start to have, you know, you have the economy of scale. So now you have to up the scale of how you think of what you have coming in, what you have exiting. And that's where you get a little bit, obviously, it's a lot more scale to manage it all.
And another note too is, you know, is that we're paying that debt off, no one's going to get money back out of that property, because things can pop up on that property. You know, the city can come in and drop some kind of lien on the property, so you try to go back and refinance it, you might not be able to get the money out of the property. So if your debt, you know, and we're hard money, but we're not, you know, we're not hard. We're not bodybuilding hard. You know, we're soft. We're soft. We got one action instead of 6 after, right? You know?
Right.
So our rates, you know, run around 6% and a half a point. You know, we got a good relationship based on our history of our production, and so we can take that risk, not having to worry about that debt being 8, 12. I remember when we first started, we were paying 12% and 3 points. 3 points.
Wow.
So that was, you know, that was more than 10 years ago. So now we're down to 6, 6.5, a half point. You know, can you manage that? We're at 90% leverage, 85% leverage. So it's just constantly, you know, shuffling around, you know, seeing what we have coming up, determining, you know, I kind of make that decision. And I'm a little more conservative, you know, because we're a little older. Do we put the money on this property? Do we put the money on that property? Do we finance this one? It's just kind of like, you know, shovel deal, you know. I would communicate with you, hey, this one's going to be a good one. And we're pretty much done. So I make this decision based on our communication amongst the three of us.
And is there any tools that help you do this? Any sort of I know you have like a spreadsheet and things like that. Or?
We have a spreadsheet, but the biggest tool is going through that 2006 and 7 and 8 time period and taking those licks then and looking back and saying, I don't want to go back to that point where you have foreclosures, short sales, and trying to recover from that. That the biggest tool is life experience. Going through the cycles and actually having failure is good because of course you experience things and you learn from that. But I would say there's no set tool you can say, okay, I'm looking at this property. The tool is just communication, knowing where the product is, and knowing where it lies, the probability of us being able to rent it, which is an extra strategy. Worst case scenario, or being able to sell it. What's worst case scenario? Being able to rent the property as an extra strategy, or being able to sell it. So we look at those areas.
Interesting.
And of course, just keeping a good pulse on the market is very important. We talk on every week.
Right.
Ask you questions, details, where the buyer's coming from, whether they want, what's their age, how's the financing, who's the loan officer. So in addition to what I read personally, it's you guys' feedback, you and Jamal's feedback is very important to me. And as we communicate on Thursday and you guys talk, we all share that feedback that you guys given us. And it allows us to think things through. Of course, what's happening on the field. The way I would think of it is like we're in a production. We're creating a product. We're restoring homes. So we're turning them around. We're creating a product. So we want to know where is our product has the highest demand. Basically the best profit margins or the best in net margin rather. And where do we need to be? Where do we need to be? Are we too aggressive? Are we a little too conservative? We want to be right at that sweet spot, because mistakes do happen, things happen that are within our control and not within our control. Whether it's with the property remodels, things that are unforeseen,
the neighbor calling on the city on us.
Whether it's the city or whether it's
something new every day.
It's something new every day. That is the hardest thing for the job. Yeah. So you keep all that in mind, and you just run it in a way where that's kind of what it is. And things just take time. I know as all young investors, I remember being in my 20s and thinking, wow, 30% return, that's not a whole lot. 20% return, that's not a whole lot. 15% return, that's not a whole lot. And as you get older, you're like, man, that's actually a pretty good return.
It's working for you.
Because it just takes, because the problem is as a young person, no one wants to get rich slow. Everyone wants to get rich fast.
They want a big house, they want a Bentley, they want a 25.
Dogecoin up
I think
1,300%.
Jeff Bezos asked Warren Buffett, and I was like, Warren, if you're so damn, you're very successul, how come all these young guys don't listen to you? And he said, because nobody wants to get rich slow. And the man's 90 years old, he's still out there. So it's interesting. It's just some tidbits, learning lessons from everything. Of course, a lot of what we're able to do is turn product is you guys' ability to help sell these homes and present them to buyers, agents, and so forth. So with that, I just want to hand that over to you and just tell us a little bit kind of what are some of the interesting stories you heard in 2020. I know the contracts have gotten sharper and thicker and fatter, and I've seen new language I've never seen before, and so I just wanted to get your perspective on that.
I mean, it's kind of gone full circle from the lockdown to where we are today. As far as the market, it's you hear it everywhere. It's one of the craziest markets. The terms are some of the strongest, and the buyers are having to come in with very, very aggressive terms, which ends up working in obviously our favor. And so we're in a great position. I think it boils down to the highest probability to close, strongest financials, and the cleanest offers. So I think that presenting the offers and looking at who's going to actually close is kind of where we're at right now. But yeah.
Yeah, it's interesting because you can feel the temperature of the agent. How many transactions have the agent closed? The questions he or she's asking during the initial phone call. When they're asking, give me the transfer disclosure statements, so the SPQ, all the disclosures up front. They're going to be kind of a difficult agent to deal with about the whole process.
Right.
You just set up to know that it's going to be so tough. If someone calls and says, hey, I control my buyer, this is going to close, I closed last year 30 transactions. Those are the agents that are going to take a lower offer on, right?
Right.
No one's going to close, and we're going to have less issues after the fact.
Right. Absolutely.
Because as an investor development company, we're responsible for this for the next couple of years, right? So those agents are easy to deal with. You can go out and fix things that are broken or things that need to be addressed. Yeah. Whereas an agent that asks for TDS and SPQ up front, and when we go through requests for repairs with knick-knack and every little thing, and we keep telling them, hey, this is the market where we're getting 30 offers, and you're asking me for the TDS and SPQ up front, that's going to be a trouble transaction. We can feel that.
Right, it sets precedence for what you can expect moving forward. There's a couple other things, like we got an offer the other day where they offered to pay for the seller closing costs. And that's personally the first time I've seen that.
Wow.
And how many transactions that we did in 2020, they said, allocate X amount of dollars towards seller closing costs. And that kind of was an outlier, something that you don't see too often, right? So that made me dig a little bit further. Well, what kind of financing do these people have? What's their intention? How many houses have they looked at before? Is this their first house? And we're going to get into escrow, and then a week down the line, they're going to get cold feet because they have some sort of buyer's remorse, or they feel that they overpaid or something along those lines. And then that takes the house off the market for 2 weeks. And so you kind of have to say, well, where are they coming from? Why do they want to pay sellers closing costs, which although it's great, but what's the motivation behind that? And that's kind of an outlier that you look into. So,
and how much actually reserves do they have? Looking at the D or LP approval. The desktop underwriting approval from the lender, right? Looking at their actual debt to income ratio, seeing what extra cash they have available in their accounts. Other than the proof of funds that they sent over. So we always look at those before we accept an offer.
Right.
Ask Keaton, hey, make sure this thing is DU, LP. He looks at that, okay, Farouk, they have an extra $150,000. They can pay $20,000 above list, and we can squeeze them a little more.
Right.
If there's issues related to the property that we disclosed to them initially, related to the roof, we're not going to do the roof. Can they have an extra cash to pay for the roof without having to worry about them coming back after us after the fact and having us pay for the roof? So things related to that in this market we can negotiate. But it's interesting because all the properties that we make offers on an investment side, we pay for the seller's closing cost fees. So that's what kind of market it is. But we're aggressive, and that's the way we get the properties. So some of those tactics being used on our side, being used on
the retail side.
And someone probably either schooled that agent up, or the agent had some experience, or they said, no matter what, wrote 20, 30 offers and said, hey, let's just try this.
Right.
Because we get the escalation clauses, $2,500 above the highest price we have. We're approved $5,000. We've seen it all this year. It's been a crazy year.
Right.
So will this continue? We hope, but like it always say, it could always go the other way. It can always go the other way.